Hello, friends, and welcome back to Seniors Radio. If you are on Social Security right now, or if you are planning to file in the next year or two, and you are still working or planning to work, I need you to stop whatever you are doing, sit down, and stay with me until the very end of this broadcast. Because what I am about to share with you today could save you from a financial disaster that quietly wipes out thousands of dollars of your Social Security benefits every single year. And the worst part, the Social Security Administration will not warn you about it. They will just process your application. They will start sending you your monthly check, and then months later, they will send you a letter saying you owe them money, or they will just stop sending your checks entirely without any explanation. I am talking about the 2026 retirement earnings test, specifically the 23,400 rule. If you are collecting Social Security before your full retirement age and you are still bringing in a paycheck, this is the single most important rule you need to understand. Get it wrong and you will lose your benefits. Get it right and you can keep your money in your pocket where it belongs. Today on Seniors Radio, we are doing a complete deep dive masterclass on this topic. We are going to cover exactly who this rule applies to, what exactly counts as earnings, because a lot of you are surprised to find out that certain types of income don't count at all. The exact math on how the penalty is calculated, how the withholding actually happens month by month, what happens to that withheld money, and no, it is not just gone forever, but there is a catch, and most importantly, the specific strategies you can use right now in 2026 to legally minimize or completely avoid this penalty. Before we get into the deep details, real quick, if you are not subscribed to Seniors Radio, please hit that subscribe button right now and turn on the notification bell. Here is why it genuinely matters. The rules around Social Security, the earnings limits, the Medicare premiums, the tax thresholds, they change every single year. The inflation adjustments happen annually, and when those numbers change, the SSA does not send you a personal explanation. They just update the policy and expect you to already know. What we do here on Seniors Radio is take those complex, constantly changing rules, break them down into plain English, and tell you exactly what they mean for your specific bank account. The people who are subscribed to this channel find out about these changes in time to protect their money. The ones who aren't tend to find out after the mistake is already made, after the checks are withheld, and after the financial damage is done. So hit subscribe, turn on the bell, and let's get into the 23,400 rule. Let's start with the big picture. Why are we even talking about this? Because the reality of retirement 2026 has changed. A lot of you are not just sitting on a porch doing nothing, you are working. Some of you are working because you love what you do, you want to stay active, you want to keep your mind sharp. Some of you are working because you have to. With the cost of living, with inflation, with the price of groceries and utilities, a lot of you realize that your Social Security check alone just isn't enough to cover the bills. So you took a part-time job, you started a consulting gig, you went back to work, and that is completely fine. The government does not forbid you from working while collecting Social Security. You have every right to work and earn a paycheck. But if you are under your full retirement age, the government has a rule that says, if you earn too much money from working, we are going to take back some of your Social Security benefits. This is called the retirement earnings test, and in 2026, the magic number for that test, if you are under your full retirement age for the entire year, is $23,400. Now, I need to be very clear about who this applies to, because this is where people get confused. The earnings test does not apply to everyone. It only applies to you if you are collecting Social Security, retirement benefits, and you are under your full retirement age. Let's define full retirement age, or FRA, because it is not the same for everyone. If you were born in 1960 or later, your full retirement age is exactly 67. If you were born between 1955 and 1959, your FRA is somewhere between 66 and 2 months and 66 and 10 months. It increases by 2 months for every single year. If you were born before 1955, your FRA is 66 or younger. Here is the golden rule of the earnings test. The month you reach your exact full retirement age, the earnings test disappears. It is gone. Once you hit that exact month, you can work, you can earn $1 million a year, and the Social Security Administration will not withhold a single penny of your benefits. The 23,400 limit, the $1 for every 2 penalty, it all stops the moment you reach your full retirement age. But for every month before that month arrives, if you are collecting benefits, you are subject to the earnings test. And in 2026, if you are under your FRA for the entire year, that limit is $23,400. Now let's talk about what exactly counts as earnings, because this is where a lot of you are going to breathe a massive sigh of relief. When the Social Security Administration says earnings, they are using a very specific legal definition. They are talking strictly about money you receive in exchange for your labor. That means W-2 wages from an employer. That means net profit from a business, freelance work, or self-employment where you are actively providing a service. But here is the critical distinction that most people miss. Unearned income does not count. Let me repeat that. Unearned income does not count against the $23,400 limit. What is unearned income? Investment income. If you have a 401k or a traditional IRA and you are taking monthly distributions from it to pay your bills, that is not considered earnings by the SSA. You could pull out $50,000 a year from your IRA and it does not count against the 23,300 limit. If you have a Roth IRA and you are taking qualified distributions, that does not count. If you sell a stock or a mutual fund and you make a $30,000 capital gain, the SSA does not care. That is not earned income. Pensions do not count. Annuities do not count. Interest from your savings accounts, dividends from your investments, rental income from a property where you are not actively providing substantial services, like running a bed and breakfast where you cook breakfast and clean the rooms. None of that counts. The earnings test is strictly a test of your labor income. So if your plan for retirement is to stop working a W-2 job and instead live entirely off the withdrawals from your retirement accounts, your pension, and your investment dividends, you can completely bypass this entire earnings test. The $23,400 limit does not apply to you. But if you're going to keep working, if you're going to take a part-time job at a local business, or if you are running your own consulting business, then you need to listen very carefully to the math I am about to break down, because this is where the penalty happens. Let's look at the math for the $23,400 rule. If you are under your full retirement age for the entire year of 2026, you can earn up to $23,400 from working, and your Social Security checks will not be affected. Not one penny. You can make $23,400, and you get to keep your full Social Security benefit on top of that. But for every 2 hours you earn above that $23,400 limit, the Social Security Administration will withhold $1 of your benefits. This is known as the $1 for every $2 rule. Let's run some real-world examples so you can see exactly how this works. Example number 1. Let's say you are 64 years old. Your full retirement age is 67. You are collecting a Social Security benefit of $500 a month, which is $18,000 a year. You decide to take a part-time job. At the end of 2026, you have earned exactly $27,400 from that job. How much did you go over the limit? 27,400 minus $23,400, $4,000. You are $4,000 over the limit. Because of the $1 for every $2 rule, SSA will take half of that excess amount. Half of $4,000 is $2,000. So, over the course of the year, SSA will withhold $2,000 of your Social Security benefits. Since your monthly benefit is $1,500, they will likely just withhold your entire check for 1 month and maybe a portion of another month to recover that $2,000. You still get to keep the $27,400 you earned from your job, but you lost $2,000 of your Social Security money. Example number 2. Let's say you are doing a bit more work. You are 63 years old. You are collecting $2,000 a month, $24,000 year to year. You work a job and earn $43,400 in 2026. How much are you over the limit? $43,400 minus $23,400 is $20,000. Half of $20,000 is $10,000. SSA will withhold $10,000 of your Social Security benefits over the course of the year. Since you get $2,000 a month, they will withhold your checks for 5 full months. For 5 months out of the year, your Social Security deposit will be $0. Example number 3. Let's say you are 62, you just claimed early, and you decide to go back to work full-time. You are collecting $1,800 a month, $21,600 a year. You get a full-time job and you earn $100,000 in 2026. How much are you over the limit? $100,000 minus $23,400 is $76,600. Half of $776 out of $600 is $38,300. SSA will to withhold $38,300 of your benefits, but your total benefit for the entire year is only $21,600. What happens here? They withhold every single check you are entitled to for the entire year. You get $0 from Social Security in 2026, and you still owe them, friends. $38,300 minus $300 and 16 is $16,700. You now owe the Social Security Administration $1,600,700. They will send you a letter saying you have an overpayment, and they will expect you to pay it back, or they will start withholding your benefits in future years until it is paid off. This is a nightmare scenario, and it happens to people who do not understand this rule. Now, I need to explain how the withholding actually happens, because a lot of people think, oh, I'll just wait until the end of the year, see what I made, and write them a check. No, that is not how it works. The Social Security Administration does not wait until December 31st to do the math. They apply the withholding monthly. When you report your estimated earnings to them, or when they see your earnings on your tax return, they divide the total amount they need to withhold by 12, and they withhold that amount from your monthly check. Or, more commonly, they just withhold your entire monthly check until the total penalty amount is recovered. Let's go back to example 2, where the penalty is $10,000 and your monthly check is $2,000. SSA will simply not send you a check for January, February, or March and May. Your bank account will not get that direct deposit. Then, in June, assuming you haven't earned any more money that puts you over the limit, your check will resume. This causes massive cash flow problems for seniors. People are budgeting based on getting a check every single month. They are paying their mortgage, their utilities, their groceries based on that monthly income. When SA suddenly stops sending the checks for 4 or 5 months, these seniors are scrambling. They are putting groceries on credit cards. They are missing mortgage payments. They are taking out high-interest loans. And all of this could have been avoided if they had just understood the $23,400 rule rule and plan their work hours accordingly. Now, let's talk about a very specific situation that catches a lot of people off guard: the year you reach full retirement age. The rules change the moment you hit your full retirement age, and in the year that you turn that age, the earnings limit is much higher, and the penalty is much less severe. Let's say your full retirement age is 67, and your birthday is in August. For the months of January through July, you are considered under your full retirement age, but starting in August, you have reached it. For the months before the month you reach FRA, there is a different earnings limit for 2026. While the under FRA limit is $23,300 for $400, the limit for the year you reach FRA is much higher, typically around $62,000 to $63,000 in 2026. The exact number is adjusted annually for inflation, but let's use the mechanism. And the penalty is not $1 for every $2. It is $1 for every $3. So if you are in the year you turn 67 and you earn $70,000 between January and July, you are only penalized on the amount over the higher limit. If the limit is $62,000, you are $8,000 over. The penalty is $1 for every $3. So you lose about $2,666 in benefits. And remember, this only applies to the money you earned before the month you turned 67. Any money you earned starting in August, the month of your 67th birthday, is completely exempt. No limit, no penalty. You can earn $1 million from August to December, and your benefits are safe. This is why knowing your exact full retirement age down to the month is so incredibly important. If you were born in 1959, your FRA is 66 and 10 months. The special, higher limit and the $1 for $3 rule only apply in the 10 months before you turn 66 and 10 months. Once you hit that exact month, the earnings test is dead and gone. Now, I want to address the biggest myth about the retirement earnings test. I hear this all the time on Seniors Radio. People call in and they are furious. They say, I earned $30,000 over the limit and Social Security took $15,000 of my benefits. They stole my money. I paid into this system my whole life and they are just taking it. Here is the truth, and you need to listen closely. The money is not gone forever. When you are under full retirement age and your benefits are withheld because of the earnings test, the Social Security Administration keeps track of every single month that your benefits were withheld. Then, when you finally reach your full retirement age, they recalculate your benefit. They essentially take those months where your money was withheld and they treat it as if you had not claimed benefits during those months. Because you claimed early, say at 62, your benefit was permanently reduced. But for every month that SSA withheld your check due to the earnings test, they add those months back into your claiming age. If they withheld 6 months of benefits, they act as if you claimed at 62 and a half instead of 62. And because you are technically claiming later, they increase your monthly benefit going forward to account for those 6 months. So you do get the money back in a way. You get it back in the form of a slightly higher monthly check for the rest of your life once you hit full retirement age. Does that make it okay? Absolutely not. Here is why this is still a terrible deal. First, it is an interest-free loan to the United States government. You are giving them your money now when you need it to pay your bills, and they are giving it back to you in tiny increments over the rest of your life without paying you a dime of interest. Second, it completely destroys your current cash flow. If you need that $500 a month to buy food and pay the electric bill, getting a slightly higher check 5 years from now does not help you keep the lights on today. Third, if you pass away early, you never get to enjoy that higher monthly benefit. Your family doesn't get that money back. So, while it is technically true that the money is not gone, treating it like a free pass to just work as much as you want and let SSA withhold your checks is a massive financial mistake. You want to avoid the withholding in the first place. Now, let's talk about the absolute biggest trap in the earnings test. And this is for my self-employed listeners, my small business owners, my freelancers. The way the IRS taxes your self-employment income and the way the Social Security Administration counts your self-employment income for the earnings test are completely different, and this difference causes massive overpayment notices. If you are a W-2 employee, the rule is simple. You count the money you actually receive in 2026. If you work in December 2026, but your employer doesn't pay you until the first week of January 2027, that money counts for 2027, not 2026. It is based on when you receive it. But for self-employment, the SSSA counts the money based on when you do the work, not when you get paid. And more importantly, they look at the hours you spend working in the business. Let me give you an example of how this trap works. Let's say you are a consultant. You are 64 years old, collecting Social Security. You decide you want to retire. You work really hard in the first half of 2026, finishing up all your major client projects. By June 30th, you stop working completely. You retire. You spend July, August, September, October, November, and December sitting on your porch, not doing a single hour of work for your business. Your clients don't pay you immediately. They pay you on net 60 terms. So in August, you get a check for work you did in May. In October, you get a check for work you did in June. In December, you get a massive final payout for a project you finished in June. At the end of the year, you look at your tax return. Your net self-employment income for 2026 is $80,000. You think, oh no, I am way over the $23,400 limit. I am going to lose all my Social Security checks. But wait, you need to report this correctly to the Social Security Administration because because for self-employment, the earnings test only applies to the months you are actually working. Since you stopped doing any significant work after June, you can tell SSA that you retired in June. You can tell them that the money you received in August, October, and December was for work performed before July. If you do this correctly, SSA will only apply the earnings test to the money you earned for work done between January and June. And because you retired mid-year, you might qualify for a special rule called the grace year rule, which can protect your benefits entirely for the months you are retired, even if your total yearly income is high. But if you do not know this rule, and you just report $80,000 of self-employment income to SSA without explaining that you retired mid-year, they will automatically withhold all your checks. You will have to fight them, send them proof of when you stopped working, and wait months to get your money back. The lesson here for self-employed individuals: you must track your hours. You must document the exact date you retire or reduce your hours. And when you report your earnings to SSA, you must clearly separate the income you received for work done this year versus income received for work done in previous years. Now that we understand the rules, the math, and the traps, let's talk about strategies. How do you legally minimize or avoid this $23,400 penalty in 2026? Strategy number 1, shift your income sources. Remember how I said unearned income does not count. If you know you are going to go over the $23,400 limit at your part-time job, look at your other assets. Do you have a traditional IRA? Instead of working those extra hours at the hardware store, stop working and start taking distributions from your IRA to make up the difference. The IRA withdrawal does not count against the earnings limit. Your Social Security check stays intact, and you are just drawing down your own savings, which you were going to do eventually anyway. Strategy number 2, timing your income. If you are self-employed, or if you have control over when you get paid, like a business owner who can take a bonus or a draw, time it carefully. If you know you are going to hit your full retirement age in August, try to defer as much of your income as possible to August or later. Once you hit that month of FRA, there is no limit. If you can push $20,000 your income into the months after you reach FRA, that $20,000 is completely protected from the earnings test. Strategy number 3, the mid-year retirement grace period. If you are planning to retire this year and you will be under full retirement age for the whole year, you can still use the grace year rules. If you retire mid-year, for the months after you retire, your benefits are protected as long as your earnings for that specific month do not exceed 1/12 of the annual limit, which is $1.50 in 2026. And D, you did not perform significant services in that month. This allows you to earn a lot of money in the first half of the year, retire, and still get your full Social Security checks in the second half of the year. You just have to report your retirement date to SSA correctly. Strategy number 4, coordinate with your spouse. The earnings test only applies to the person who is collecting the benefit. If you are 63 and working, and you claim Social Security, your earnings will reduce your check. But if your spouse is also collecting, and your spouse is already over their full retirement age, your earnings do not affect your spouse's check at all. Furthermore, if you are 63 and your spouse is 62, and you both claim your high earnings could reduce both of your checks. In some cases, it makes sense for the lower earning spouse to claim first, or for the higher earning spouse to delay claiming until they reach full retirement age, completely bypassing the earnings test. You have to look at your household income as a whole, not just your individual check. Now, what if you have already made a mistake? What if you are listening to this right now in 2026 and you realize, oh my goodness, I have already earned $40,000 this year, and I claim Social Security at 63. I am going to get hit with a massive penalty. First, do not panic. Second, you need to be proactive. Do not wait for the SSA to catch you. If you know you are going to owe them money, you contact them and set up a repayment plan. They will withhold a certain amount from your future checks until the debt is paid off. It is better to negotiate a manageable monthly withholding than to have them suddenly demand a lump sum of $5,000 that you do not have. If they send you an overpayment notice and you absolutely cannot afford to pay it back because it would deprive you of food, shelter, or medical care, you can file for a waiver. You can file Form SSA 632, Request for Waiver of Overpayment Recovery. If you can prove that the overpayment was not your fault, which is hard to prove if you just didn't know the rule, but possible in some complex self-employment cases, and D, that repaying it would cause financial hardship or be unfair, they might waive the debt. But getting a waiver is difficult. The best strategy is always to avoid the overpayment in the first place by estimating your earnings correctly at the beginning of the year. When you file for Social Security, or when you start working while collecting, SSA will ask you to estimate your earnings for the year. Be honest, but be smart. If you know you are going to make exactly $23,400, estimate $23,000. Give yourself a little buffer. If you end up making $23,400, you are safe. If you estimate $23,400 and you actually make $30,000, you will have an overpayment. Let's bring all of this together. The 2026 retirement earnings test is a complex web of rules, but it all comes down to a few core principles. If you are under full retirement age for the entire year, your limit is $23,400. For every $2 earned over that from working, you lose $1 in benefits. If you are in the year you reach full retirement age, the limit is much higher, around $62,000 or plus. The penalty is $1 $12 for every $3, and it only applies to the months before your birthday month. Once you reach the exact month of your full retirement age, the earnings test disappears completely. You can work and earn unlimited income without losing a penny of benefits. Unearned income like IRA withdrawals, pensions, and investment income never counts against the limit. Only wages and self-employment income count. The money withheld is not gone forever. It increases your benefits slightly at full retirement age, but it is still a terrible deal because it ruins your current cash flow and acts as an interest-free loan to the government. Self-employed individuals must track their hours and report their retirement date correctly to avoid penalties on income received for work done in previous months. Your action plan for today is simple. Step 1. Calculate your exact full retirement age based on your birth year. Know the exact month it happens. Step 2. Estimate your W-2 and self-employment income for 2026. Step 3. Compare that number to the $23,400 limit or the higher limit if you are reaching FRA this year. Step 4. If you are going to be over the limit, look at your budget. Can you reduce your work hours? Can you shift to drawing down your IRA instead of working? Can you defer income until after you reach FRA? Step 5. If you are self-employed, document your exact retirement date and track your hours so you can prove to SA when you stopped working. Step 6. Call the Social Security Administration at 1-800-777-T2-1213 and report your estimated earnings for the year. Get it on the record so there are no surprises. Working in retirement is a reality for millions of Americans in 2026. There is no shame in needing or wanting to work, but there is no excuse for letting the Social Security Administration take your hard-earned benefits because you did not understand a simple rule. The $23,400 is not a suggestion. It is the law. But by understanding how it works, what counts, and what strategies you can use, you can keep your money in your pocket. If this deep dive on Seniors Radio helped you understand the 2026 earnings limit, please do me a favor. Hit that subscribe button, share this broadcast with a friend, a spouse, or a neighbor who is still working and collecting Social Security. You might just save them from a devastating overpayment notice. One conversation can change someone's financial situation for years. I am your host, and this has been Seniors Radio. Stay informed, protect your benefits, and I will see you in the next broadcast.